What's up, penny boys and gals? It's your boy, What the Duck here, and it's time for the start of our second week of PBU. Our first two classes can be found in the PBU class channel. They're about 10 minutes each for those who missed it. You can skip over the live stream Q&A if you're trying to catch up and have a limited time. That's just a question and answer and going over the homework. But be sure to check out those first two classes, the ones that are 10 minutes each, in the PBU class channel if you're trying to catch up. Today's class is going to be going over our PBU buy-in method as well as our bankroll strategy. If you buy a stock or go into the stock market without a strategy, well, then you're just gambling. However, if you have a strategy, an exit plan, as well as an entry plan, well, then you're trading. So today is about step one of that strategy as well as the entry plan. So, what is the PBU buy-in method? Well, the simple way of putting it is that it's a way of buying into an alert or stock in a patient manner, with the goal being to get the best average possible while ridding yourself of as much risk as possible and getting you the best potential profit in the process. So, how do we do this? Well, PENNYBOIS stock alerts is not about chasing stocks. It's not about pump and dump scams. It's about turning you into a real trader. We're not just following the Webull top gainers list or buying all into whatever the hot stock on Stock Twitch chat is. People can make money by doing this, but that's out of pure luck. And luck is for losers. And in the stock market, luck is for gamblers. PENNYBOIS is about trading, not gambling. It's about skill, not luck, because luck runs out. Skill you can use forever. We use due diligence and technical analysis to find a stock that has potential for profit, and our goal is to find it before anybody else does. But in order for this to happen, it means that the stocks we pick are going to take time. They're going to take patience, because they're going to consolidate before they run. Consolidate means it's going to trade up and down for a little bit before running to the targets. The reason that we do this is we want to get the best average possible. That way, when it starts to run, we're sitting pretty with an average of, for example, 90 cents, while everyone else, such as the Stock Twist comments and Webull comments, are all shouting, buy, 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 this stock is running when it's at $1.25 or $1.30. We got it at 90 cents. So in order for this to happen, we need to buy in a way that will help us get the best average possible while at the same time ridding us of as much risk as possible. So here in PBU, we call this the PBU buy-in method. Some people in PENNYBOIS might refer to it as the 25-25-50 rule, but I don't like to call it that personally, and you'll see why in a little bit. The reason why PENNYBOIS calls it the 25-25-50 rule is because the way it works is by buying, for example, 25%, 25%, and then 50%. But what does that mean? Well, to start, before you enter a play, you need to figure out how much you plan on putting into that play. So for example, let's say that you plan on putting in $100 to stock XYZ. This means that you're not going to let yourself put more than $100 into that stock, because once you start to do that, you're no longer finding a good average, you're averaging down, and you're breaking your plan. And remember, once you veer off of your plan, then you're gambling, you're not trading. Okay, so let's say that you plan on putting $100 into alert XYZ. Now remember, these are not pump and dump alerts, and they aren't alerts chasing the current running stocks. So what we do is we buy small. For example, we'll put 25% of the amount that you plan on putting into that stock. So for example, 25% of $100, because you plan on putting $100 into stock XYZ, would be $25, because $25 is 25% of $100. So you put $25 or 25% into stock XYZ, and then you wait, you watch, and you let it consolidate. And when it hits a strong support, you add another 25%, or in our example, another $25. Now your average is lower, meaning that you have the chance to make more profit once it runs. So then you wait some more, you watch some more, and when you see it bounce off of a strong support and start showing some upward confirmation, that's when you make your final buy, your 50% buy, your $50 buy in our example. Upward confirmation means that it's showing strong movement up and might start running. You figure this out by using indicators, which we'll be going over in our future classes. So, why do we do this? Well, by buying in a little bit at a time, you're going to get the lowest average possible, and the lower your average, the more profit you can make when it runs to the target. Also, if you were to buy all in at once, then you risk becoming a bag holder if it drops, or you risk stopping out if it drops. When you buy in small, you're getting a better average when it drops. So why do we not call it the 25-25-50 rule in PBU? Why do we call it the PBU buy-in method? Well, because 25-25-50, or the 25%, 25-50%, is just a guideline. It's just an example. It's a suggestion. You don't have to use those exact percentages. You can start out with a 10% buy-in, then another 10%, then a 15%, then 15% again, and then a 50%. That would be a 10, 10, 15, 15, 50. You can do a 5%, 15%, 20%, 30%, 30%, which would be a 5, 15, 20, 30, 30. So it doesn't have to be 25, 25, 50. You can do whatever percentages work for you. The point of the PBU buy-in rule is buying in slow and taking advantage of the consolidation and the dips. Sorry, my screen just blanked out on me. And getting the best average possible. Now, that's one way of using the PBU buy-in rule. This requires watching the charts, knowing the indicators, and having patience. But what if you work a 9 to 5? What if you're an emotional trader? What if you don't know the indicators? Well, then your best bet is using this rule with percentage drops. What does that mean? Well, it means finding the best percentages that work for you as far as your buy-in goes, meaning 25, 25, 50, 10, 15, 20, 25, 30, 5, 10, 15, 20, 25, 25, you get the point. You find which percentages you want to buy in with, and then you decide a percentage drop. Well, what's a percentage drop? Well, it means you decide, I'm going to buy every time this stock drops 1%, or I'm going to buy every time this stock drops 1.5%, or 2%, or 2.5%, or even 3%. And then you set your limit buys based off of that, and you walk away, and you let the rest happen on its own while you're at work, or riding your bike, or doing yoga, or making a Nutribullet, or whatever it may be. So, for example, let's say that you choose a 10, 20, 30, 40% buy-in method with a drop percentage of 2%. This means that you start out with your first buy, and then every time that it drops 2%, you make your next buy. So with this 10, 20, 30, 40 example, if you're using $100 total, you would make a $10 buy. Then, when the stock drops 2%, you'll make a $20 buy. Then when it drops another 2%, you make a $30 buy. And when it drops another 2%, you make a $40 buy. Now you're in 100%, or $100, and you have a great average. Now you're ready to set your stop loss and take profit, limit sell, and walk away. We'll be going over that more in detail next class as far as the stop loss and the take profit, limit sell goes. Now you're probably wondering, how do I know what the 2% drops are as far as the prices go? Well, you can make a spreadsheet using Excel and math to make it so that you can insert your initial buy-in price and Excel can do the rest for you and just tell you what each price would be once it drops 2%. But if you're not good at Excel, you can just guesstimate. Me personally, I'm not very good at Excel, so I just kind of guesstimate. I'm also working on possibly making an Excel sheet for all the members in PBU to just be available for PBU. I believe Pookie's Revenge actually might already have one out there. I'm not 100% sure, but if he does, I would definitely ask him. He is really, really good at those Excel sheets. If not, you can make your own, or you can just guesstimate. There's, if you're off a couple of pennies, it's not a big deal. You can also combine these two methods, doing the drop percent rate and the buy-in method up until your last buy, and then waiting for upward confirmation to make your last buy. So that means using the 2% drop rate or the 1% drop rate or whatever drop rate you want to use until you get to that last buy, and then you wait for upward confirmation and make your buy. So that's a combination of using a drop percent rate and using the 25-25-50 rule. The first way we went over is better for more advanced traders who have time and are able to follow the charts and know how to read indicators. The second way we went over, the drop percentage, is better for new traders or traders who work 9 to 5. It's the more hands-off, stress-free way of trading. And the third way, which is the combination, is kind of good for an in-between. It's kind of good for people who are starting to learn the charts, starting to learn the indicators, but still don't want to, still either don't have the time or still don't want to be watching the charts 100% because they don't know exactly, like 100% what they're doing. But it's a good way of kind of easing yourself into chart reading and indicator reading. But the end game for all three is the same. It's trying to get the best average possible while putting yourself at the least amount of risk. And if the stock starts to run before you're able to make all of your buys, then you have two choices. Make a quick last buy if you catch it in time, or just let the stock run while you're not fully in. Using the PBU buy-in method, that's your only risk. You're risking a stock running while you're not fully in. You're still making money though. By not using the PBU buying method, you're risking becoming a bag holder, or even worse, getting stopped out of the majority of your plays you take for a loss, and those will add up. Keep in mind with day trading, it works a little bit differently because day trades are fast plays, and you really need to know how to read indicators in order to day trade, or just be really lucky. So, you might be wondering, how do I decide how much to put into each stock? Well, that's what we'll be going over next, the PENNYBOIS bankroll strategy. So, our bankroll strategy is a way of diversifying your portfolio. And we'll go over the importance of that in one of our future classes. But the short reason why we diversify is because if you go all in on one stock, you're putting your whole portfolio at risk. If that stock goes down, you can lose a lot of money. By spreading your portfolio out among different stocks, you're putting yourself at less risk, and you won't lose as much money if one of your stocks goes down because you're diversified. So our bankroll strategy goes as follows. We allocate 10% of our total portfolio into each play, meaning the max that we will put into each play is 10%. Or if you're really confident about play, then 15%. So if you have $1,000, you're putting no more than $100 or $150, if you're really confident, into each play. This doesn't mean that you have to put $100 into each play. If the stock runs before you're fully in, let it run, like we went over earlier. And if you're not very confident, you can always just plan on putting 5% into a play. Also, the plan isn't to use your whole bankroll, meaning your whole portfolio. Typically, you want to use only about 70 to 80% of your total portfolio. Why? Because there might be an unexpected play or scenario that you want to have money on the side for, like an Apple or Tesla forward split, or a big drop in a stock. So for a recap, you allocate 10% per play, 15% if you're confident, and you want to keep around 20 to 30% of your portfolio in cash in case something comes up. All right, I hope that helped. We also do have the handouts. The handouts are going to be in the PBU class channel. You actually had to go into that channel in order to get to this class, so you definitely know where it is. Actually, you had to go into the handout in order to look at this class. So the handout goes into all this stuff in very big detail, so I definitely would recommend reading over that handout. It goes over the drop percentage in detail with examples. It goes over the 25, 25, 50, and its different variations in detail, as well as the whys and the what's behind all of them. So next class, we'll be going over how to follow an alert, how targets and entries work, stop losses, and setting profits, and setting trading expectations. I'll be posting the homework in that e-handout that you had to get into in order to find this video. So make sure that you complete that homework. If you get 100% on the multiple choice, you will get a raffle ticket. And the best 3 answers for the not multiple choice questions, for the fill in your blank questions, will get raffle tickets as well. And we'll be going over all that in Thursday's live stream. Also make sure to join me, What the Duck, at 9:30 p.m. Eastern Time Zone tonight. That's Tuesday night. And I'll be doing a Q&A going over today's class and today's homework. I won't be answering any of the questions for you, but I'll be giving you kind of like a a little bit of a help, some hints and hints and tricks and all that good stuff. So join me, What the Duck, at 9:30 p.m. Eastern Time Zone for that live stream, so that together we can make some bread.